Welcome back to the deep dive. So we've got a comprehensive stack of sources from you all, and they're all focused on what is, well, arguably the single largest fiscal challenge facing the global economy right now.
hmm
The rapidly, and I mean relentlessly, growing U.S. national debt. It's a problem measured in trillions, it's being made worse by compounding interest, and it's accelerating.
It absolutely is.
So our mission today isn't just to, quantify the brutal math, we'll get to that first, but to really analyze this fascinating and I think critical shift that's happening in financial policy.
Right.
We're looking at how digital assets, specifically the blockchain infrastructure underneath them, are being reframed.
Yeah.
It's no longer just this radical anarchic hedge against the system.
Not at all.
Instead, the argument now is that this tech is a potential plan B.
Mm.
An incremental functional upgrade to the financial plumbing we already have, designed to ease this colossal pressure.
Okay.
Let's unpack this.
And if we want to understand the solution, we absolutely have to start by internalizing the sheer scale of this crisis. I mean, the reports lay it out, and the numbers are they're staggering.
So what are we talking about top line?
As of late October 2025, the U.S. gross national debt is sitting at approximately $38 trillion.
38 trillion.
But look, the absolute number, as huge as it is almost less alarming than the velocity of the growth.
Just D.
The speed. Treasury Department reports show that the U.S. added $1 trillion to that total in just 2 months.
Wow.
Between August and October of 2025. I mean, that rate of increase is unprecedented outside of, a major war or a severe economic crisis. And that's the key reason policymakers are scrambling.
That scramble is critical. So let's dig into the annual cost, because servicing this debt has completely warped the federal budget, hasn't it?
It really has.
Our sources show the annual federal deficit is getting close to $1.8 trillion for the 2025 financial year. But the real kicker, the consequence of all that spending plus high interest rates, is the cost of borrowing.
That's where the pain is.
We're now talking about roughly $1.2 trillion a year, just servicing the debt.
Just interest payments.
That's more than $3 billion a day. A day. Just in interest.
And to give that some scale for everyone listening.
Yeah, please.
That $1.2 trillion in annual interest is about the same as the entire annual defense budget.
The entire thing.
Or, look at it another way, it's about 3 times what the federal government spends on education every year. So debt service isn't a side note anymore, it's a central cost, and it's directly competing for funds.
Right. It's taking money away from crucial programs.
The magnitude of this really forces you to stop and think about how profoundly interest rates now dictate fiscal policy. I mean, that was almost unimaginable 5 years ago.
Yeah.
And while the credit card comparison is useful, that single quarter borrowing of over $1 trillion is close to all U.S. credit card debt.
Right.
The real danger is the feedback loop. This is the debt doom spiral that the sources keep warning about.
Explain that. What is the doom spiral?
Okay, so high interest rates increase the cost of servicing the debt. That expands the deficit.
Which means you have to borrow more.
Exactly. The Treasury has to issue more debt, which can pressure liquidity and requires either massive new borrowing or printing money, and both of those things contribute to inflationary pressure.
So it feeds on itself.
It feeds on itself. It doesn't guarantee a collapse, but it dramatically raises the structural fragility of the economy.
And it's precisely that structural pressure that brings us to the core idea of this deep dive. Digital assets can't just, make a $38 trillion debt disappear.
Of course not.
But the argument in these financial white papers is that when your balance sheet is in the trillions, even tiny incremental gains matter immensely. If you can shave a small percentage off borrowing costs or expand your pool of buyers by just a few percent, the effect is in the billions.
Absolutely. The perception has fundamentally changed. We're past the point where the focus is on some speculative crypto coin. The mature conversation now is recognizing that the foundational crypto infrastructure, blockchain, smart contracts, stable coins, it's all matured into stable, functional financial plumbing.
Financial plumbing. I like that.
And the specific operational efficiencies this plumbing offers are exactly what's needed to stabilize things at the margins. So we're talking about tangible benefits.
Like what?
Improving liquidity access, dramatically speeding up settlement cycles, and expanding the global investor base for U.S. securities.
Okay, you mentioned a bit of jargon there. Near immediate finality. Let's clarify. What does that actually mean for, say, the Treasury or a big bank?
It means you get your money, or rather the security settlement, confirmed in seconds, not the 2 or 3 days the old T+2 system takes.
The seconds versus days.
Right. And when the Treasury is moving trillions, reducing that settlement risk, and the collateral required for 3 full days down to mere moments, it just frees up capital across the entire financial system. That reduction in friction saves billions in operational costs.
And a huge factor driving this is just availability, right?
Yeah.
Making it palatable for big institutions.
Exactly.
The moment the SEC approved spot Bitcoin EPS, and now with all the interest in Ethereum ETFs, that was monumental. It lets massive funds get exposure without the headache of actually holding the asset.
The custody issue is a huge barrier. This removes it.
And now these regulated ETFs are available right next to your S&P 500 funds on Fidelity, Schwab, BlackRock's platform. That seamless integration just makes it an easy, palatable part of a portfolio.
What's fascinating here is how this rising institutional demand is happening at the exact same time as a major macro shift in who is buying U.S. debt.
Okay, what's that shift?
For the better part of a decade, major foreign investors, countries like China and Japan, they've been gradually reducing their holdings of U.S. treasuries.
They're selling off.
Or just not buying as much. They're prioritizing their own domestic needs, diversifying reserves. This trend forces the U.S. to rely more and more on domestic buyers and short-term funding markets.
Which can be more expensive.
More expensive and more volatile. So this structural change makes new, globally accessible funding rails, like the ones tokenization provides, not just helpful, but I'd argue increasingly essential. You have to find new sources of capital.
Which brings us to the first specific mechanism, tokenized treasuries. Explain what these are and why they matter so much right now.
So simply put, these are U.S. treasuries that are essentially wrapped into on-chain shares or tokens.
Yeah.
These tokens represent ownership, and crucially, they allow the assets to operate 24 hours a day, 7 days a week.
Which is key, because traditional treasury markets are stuck in U.S. time zones. But global demand for safe dollar assets never sleeps.
That 247 access solves a massive liquidity problem for global investors. But even more critically, tokenization allows for fractional holdings.
Meaning you can buy a small piece of a bond.
Exactly. Suddenly, a $100,000 bond can be bought by a retail investor or a small fund anywhere in the world in, say, $100 chunks. This just dramatically broadens the buyer base, drives up demand, and could potentially push down the interest rates the government has to pay.
And these tokenized instruments can then be used for other things.
Yes, they can immediately be used as collateral on DeFi platforms. And we can define DeFi more clearly in a bit. But that utility goes way beyond just being a safe place to park money. More utility means more demand, which is exactly what the Treasury needs right now.
Here's where it gets really interesting, because the data shows this isn't theoretical anymore. Let's look at the institutional numbers.
Yeah, they're big.
BlackRock's IBIT, their spot, Bitcoin Trust, held around $80 billion in assets as of November 2025.
$80 billion.
Total crypto fund assets under management hit $167 billion in mid-2025. And U.S. spot crypto ETFs pulled in over $29 billion in net inflows through August 2025.
These are serious, sustained institutional allocations. This isn't a fleeting gamble anymore. It's legitimate portfolio exposure.
And this institutional maturity leads us to the scale available through stablecoins.
Right. The reports highlight that stablecoins, these are digital tokens pegged one-to-one to the U.S. dollar, are generating this immense regulated global demand for dollar assets. JP Morgan is predicting that stablecoins could generate additional global demand of up to $1.4 trillion by 2027.
1.4 trillion.
In a practical sense, stablecoins offer far lower transaction costs and much faster cross-border transfers than old banking systems. So think about the cost savings for the government when it's distributing foreign aid or paying international vendors. You get instant finality, not slow, expensive correspondent banking.
That 1.4 trillion forecast is huge. But doesn't that concentration of liquidity, trillions of dollars relying on a handful of stablecoin issuers, doesn't that just trade one fiscal pressure for a massive new systemic risk?
That's an excellent and necessary challenge.
I mean, if the U.S. debt relies on this funding rail, and a major stablecoin issuer gets in trouble, that becomes a new point of fragility, right?
It does, and the sources make it clear that the regulation has to evolve right alongside the adoption. And that actually brings us to an interesting byproduct that helps stabilize the system: tax compliance.
How so?
Well, as digital assets go mainstream, the IRS has finalized new reporting rules for crypto sales and exchanges. Those start in 2025. A unified, clear reporting method is essential for stabilizing the market.
And it makes it easier to collect taxes.
It boosts compliance significantly, so the government can collect billions in tax revenue that might have been missed, which eases revenue constraints and formalizes the market at the same time.
Okay, now, we have to keep a balanced view here. The promise is significant, but the sources are very clear that this tech isn't without risk, especially for governments. So let's look at the major limitations.
There are three big ones. First is just volatility. Bitcoin and other assets, even regulated ones, are fundamentally volatile. Any public entity using them has to size those positions carefully and be ready for big downturns.
Okay, that's a constant. What's second?
Second is regulatory risk. The trend right now favors adoption, but the rules are still new. Policy can shift fast depending on politics or economic pressures. You need clear, durable protections, especially for stablecoin reserves and auditing, to have long-term confidence.
And the third risk, this touches on the complexity you mentioned, is operational risk.
Yeah.
But for the listener, let's quickly define the jargon that creates this risk. What exactly is decentralized finance, or DeFi, and what are cross-chain bridges?
Good call. So DeFi is basically a system of lending, borrowing, and trading using smart contracts completely outside of traditional banks. It's permissionless, but often highly complex and, frankly, experimental.
Okay, and bridges.
Cross-chain bridges are the specific tech that lets you move assets between different blockchains, like from Ethereum to Solana.
And that's where the risk comes from.
That's where a lot of it is. DeFi platforms can have technical bugs, and those bridges are frequent targets for very sophisticated hacks, often leading to huge losses. When you're talking about government or institutional money, that kind of operational risk is just unacceptable.
Which leads directly to the practical guidance our sources suggest. Public entities should prioritize the simple solutions.
Right.
Things like regulated stablecoins and Bitcoin ETFs. They have established liquidity, regulated on-ramps.
Stick to what's proven.
Exactly. Avoid venturing into the complex experimental tech in DeFi and these cross-chain systems. Simplicity minimizes your operational risk while still getting you the speed and efficiency you need to manage trillions.
So to tie this all together, the core finding is that the focus has shifted entirely. Crypto's promise isn't about, revolutionizing the whole fiscal structure overnight. It's about providing incremental but massive relief. Relief through efficient funding avenues, expanded global demand for dollar assets, and lower operational costs. So it's less of a radical hedge against the system collapsing and far more of a sophisticated, maybe even necessary upgrade to make the current system faster, cheaper, and more robust.
So what does this all mean for you, the taxpayer, the global investor?
Yeah.
The narrative has fundamentally changed. The technology, with its regulated ETFs and tokenized assets and clearer rules, is maturing, just as U.S. fiscal pressure is mounting to these critical, undeniable levels. The focus is purely utilitarian now. It's about finding a way to make the system run faster and cheaper, to manage a debt load that shows no signs of slowing down.
And here's the final provocative thought to leave you with based on all these numbers. If the global demand for dollar-backed digital assets like stablecoins and tokenized treasuries helps fund the U.S. debt by trillions, does this technology simply buy the government time, maybe 5 or 10 years, to finally address the fundamental budget imbalance? Or does that vastly expanded global access to capital fundamentally change the risk equation of that dreaded debt doom spiral, pushing the ultimate reckoning much, much further into the future? We'll leave you to think on that.